Okay. Hello. How's it going, everybody? Welcome to a capital hungry, top down, full fundamental and technical analysis on US 30 stock market index. Can you guys hear me loud and clear within the YouTube audience? You should be able to see a US 30 weekly chart, as well as you should be able to hear me loud and clear. Okay, so I'm going to be doing a full higher time frame to intraday time frame analysis on US 30, explaining stock market fundamentals, key foundation points, market cycles, fundamental catalysts, central banking impact, and a lot more. Okay? So hopefully everybody's here. They got their notepad, you got your pencils, because it can be a pretty long webinar. And of course, I do want to give as much information as possible, but for those of you who have low attention span, for those of you who do not have the patience for this, I suggest turning it off now, because this is going to be a very information-filled webinar for the next 30 to 60 minutes. Okay, so let's talk about the US stock market. All right, now we have to understand basic fundamentals and foundation points. For those of you who are unaware, the stock market is essentially created and designed, of course, by man to go up in value, to increase the value of wealth for the few at the cost and expense of the many. The stock market is designed based on human psychology and greed to extend wealth for those who are primarily invested. The main people that are usually invested into the stock market are the top 10% of society. Ones with a much higher income, ones with more access to information and resources to, of course, get themselves involved in this space. So number one, the stock market overall from basics is designed by human psychology and greed and is designed in normal function to go up. But of course, nothing goes up forever. Everything follows a cyclical process. Everything within our life is a cycle. So as the market is designed, eventually you have various phases in market cycles where you see liquidation out of the market and buyers flooding out of the market with more short sellers jumping in, creating very aggressive market waves, corrections, and crashes that is usually induced by a fundamental catalyst. But to the mainstream, every time you have a market collapse or crash, to the mainstream masses and to the general public, it is always shown as so much chaos, so much uncertainty, and so much confusion. But at the end of the day, every single market crash or correction has been induced by human greed or human decisions. And at the end of the day, every crisis in the financial market, no matter how badly it affects the middle class, working class, and general public, it always creates opportunity for the rich. So one, we understand that in normal function of the stock market designed by human greed, it is designed to go up in value. And it is designed to extend the wealth of the few who are invested into the market, which is usually the top 10% of society. Two, after every 10 to 15 year period with an excessive stock market rally or with any other fundamental catalyst to induce it, you always have some type of crash or some type of correction in this rally, which really just ends up being the whales and market makers liquidating from better price points of interest, creating mass panic and chaos for the general public, and also that liquidation of positions and more short sellers jumping in during that period of chaos and crisis ends up creating a very aggressive crash or correction. But at the end of the day, remember, the normal function of the stock market is to go back in value. So all of these corrections and crashes really just creates an opportunity for the same rich who are benefiting off the previous rallies to enter back in the market from better price points of interest, and this cycle continues to repeat through history. There's never been a period of time where the stock market has fully crashed and stayed crashed. Every single crisis, every single correction, whether it's induced by a fundamental catalyst like war, whether it's induced by something like the Great Depression, whether it's induced by something like 2008 and the global financial crisis, whether it's induced by the 2020 pandemic and global lockdowns, or whether it's induced to the aggressive rate hike cycle by central banks. Every single correction or crash in the market, whether it is small or large, has always found some type of grounding, because overall it creates a better opportunity for the rich to reinvest their previous earnings into better price points and continue to extend the normal function of the market, which is to go up, right? So some key takeaway points. The market in normal function is designed by human nature and human greed to go up in value and extend the wealth of the few invested. Every 10 to 15 years, or even sooner, based on a fundamental catalyst, you have very frequent corrections or crashes, but those crashes and corrections, even though you can anticipate it, even though you can call it, even though it creates such chaos and such confusion to the general masses in public, it always ends up being a dip for stock market buyers, the market makers, the whales, to load up from better price points of interest and continue the overall cycle to the upside. And every single time there is a stock market correction or crash, the cartel of the currency, in this case, we're looking at the US stock market, but the same ideology can be applied to any global stock market. The cartel of the currency, aka the central bank, works in hand with the government in power at that time and always bails out the financial markets. So now we're going to talk about the next set of important information. Our global economies, our jobs, our taxes we pay, the wages we earn, the rent we pay, the cost of living, it is all far too heavily connected to the global stock markets for the stock markets to ever have a true failure. If the stock markets actually ever fully crash and have a true failure, the entire economy essentially collapses. The banks and institutions and corporations at the top below the central bank, they have to obviously have that huge ripple effect of jobs being lost, of jobs being destroyed. That has a huge ripple effect to the middle class and working class, and would lead to a pretty much economic collapse and be a situation far worse than a depression. Okay? So every single time in history, whenever there has been a significant fundamental catalyst inducing a lot of negative volatility to the stock markets, creating this process of a cycle that continues to repeat throughout history, the cartel of the currency, aka the central bank, who dictates money supply magically, who dictates the lending rates and economic stimulus down the line, dictates credit allocation and so forth, they always work in hand with the government to bail out the financial system, which in turn makes them way richer and also continues to save the economy, which is the message sent to the public and masses, right? Let me give you an example. In 2008, what we saw take place here in 2008 was the market have an extended rally for almost a decade prior to the Y2K period. The last bit of a stock market correction really that's well notable besides 2008 was the year 2000, where you had a bit of that technological scare and coming out of that whole dot-com era, right? So then for that decade period, after that after that year 2000 correction, you can see the stock market had an extended rally for almost 10 years, all the way until 2008. 2008, a fundamental catalyst came into play that induced a lot of negative downside volatility into the stock markets and overall US economy, which was the 2008 global financial crisis. The global financial crisis was pretty much created by human greed. Mortgage-backed securities in the US collapsing because mortgages were being handed out like hotcakes and candy, and the majority of them were relatively dirt, garbage and valueless. But you had this whole financial system pretty much being propped up by this investment in real estate and mortgage-backed securities and mortgage bonds and so forth, that was all propped up on garbage, right? So then when it came to play that the majority of citizens would not be able to pay back their mortgage debts, mortgage and so forth, you had this huge economic crisis which led to this crash. Now, think about this. The central banks and government can jump in at any time to start to stimulate the economy, to start to bail out the banks, and to start to support the markets. But the GFC came into play, which was very well known on an institutional perspective, that human greed extended this deficit in the mortgage-backed securities system and led to that collapse of the mortgage-backed securities that led to the 2008 global financial crisis, and obviously that huge ripple effect globally and mass market fear. But the crash or correction came from all-time high price points at that time after a 10-year extended rally, and the central bank waited before providing any economic stimulus or jumping in to keep interest rates low and start bailing out the banks. They who have the power to jump in at a whim, to jump in at any moment and drop interest rates and provide economic stimulus on top of increasing money supply to pump the markets through their asset purchase program, they chose and allowed the market to have that crash for almost a year period there. Because remember, every single crisis, every single crash creates an opportunity. Then at this crash point, they hit the short circuit breaker and don't allow any more short selling in the market, and the Federal Reserve jumps in to bail out the banks and of course provide economic stimulus through their asset purchase program and an increase in money supply, which then years later, you see within 2 years, you're already back to pre-crash levels and even higher. Once the central bank jumps in to provide that support through their stimulus and asset purchase program, who do you think is riding this wave and jumping into this crash point? Do you think it's your mom and pop and the day-to-day working citizen who is just having inflation through the roof, who just potentially might have lost their job in relation to the ripple effect of the impact to the financial sector, who's going through economic turmoil and seeing all this panic in mass media and news? You think they're the ones involved in the market here? No. This is the same whales who have been extending that rally, the same institutions, the same ones working in hand with the central banks that buy into there and have their wealth further extended until the next real economic catalyst comes into play. Then, from 2010, pretty much when you start to have the 2008 financial crisis fade out, you have another decade-long rally, and then the pandemic conveniently hit the scene. Remember, you had a huge rally from crash points. You only saw corrections when interest rates started to go back up, and those were very short-term corrections, or you had a little bit of uncertainty during the Trump trade war era, right? But you didn't see another correction or crash until you had the 2020 pandemic a decade later, right? But look at the same thing. After a decade-long rally in the stock markets, at that time, all-time high price points, you have COVID come into play and a global pandemic, right? Remember, the actual COVID pandemic and virus isn't what led to an economic collapse. It was the decision of governments around the world locking down economies and economies becoming stagnant that led to economic collapse. Huge drops in economic data, huge drops in economic activity, economies being stagnant and frozen at a standstill. Of course, you're not going to have any prosperity within the economy, except for the ultra rich and ultra wealthy, right? So then, after a 10-year rally at all-time highs at that price point, you have a huge crash that takes place, and this crash takes place for almost a month. It was at March 2020, after the crash took place and Dow Jones US 30 hit 18,000, that then the Federal Reserve and the markets put the short circuit breaker, not allowing any more short selling, and then you had the Federal Reserve come into play. And of course, the Federal Reserve being the cartel of the currency, on March 2020, they came to bail the markets out, right? Same date here on March 2020, after they allow the market to crash, to wipe out 5 to 8 years of gains in the market, to allow the people to panic. Everybody, this mass pandemonium, this huge panic in day-to-day media, everybody's life is all confusion and chaos. As that's all happening in the mainstream, you have this huge opportunity created, right? You just have the stock market go to freaking 8-year previous price points, have a huge crash and low created. At the same time, the cartel of the currency, the central bank, Federal Reserve, says we're going to exponentially increase our money supply and start QE, start quantitative easing and their asset purchase program. At this time, interest rates are low, which makes lending easier down the line, and more loans being taken out from an institutional perspective that's going back into investments into the stock market, because the stock market is just at record low prices. You're having the Federal Reserve, the cartel of the currency, coming in and saying we're about to support it and bail the market out again like we have before in history. Interest rates are low, prices are low, money supply is increased, which naturally increases economic inflation, and inflation also inflates the price of everything within an economy, and the central bank is taking that money and flooding the markets with it through their asset purchase program, right? So here you have a US money supply chart. You can see on March 2020, when the Feds printed almost $18 trillion, and only $2 trillion of those dollars went to the day-to-day consumer and citizen, the other $18 trillion went into pumping the markets. And from that dip, from this dip here, you see $18 trillion going into their asset purchase program for buying mortgage-backed securities every month, buying government bonds, buying, of course, stock market ETFs, and all of that, which just goes back into investing into the stock market. The government gets that money, the corporations get that money, they all ride the wave to go in the stock market. From very low prices, one factor, low interest rates, inflation going up because money supply just exponentially increased, the Fed's taking that money supply and pumping the markets, all the institutions in Wales riding that wave, right? From this period of time, from 2020 to 2021 and onward, for the general public, they were facing losing their jobs, they were locked down, they just had their livelihood destroyed, small businesses destroyed, inflation and cost of living is going through the roof, as you can see on this CPI chart here, which conveniently on March 2020, the same time money supply was exponentially increased, you had a huge surge in consumer cost of goods. So the day-to-day citizen is having the buying power of their currency drop, cost of goods go up, in a mass panic because of the pandemic, and mass fear because of what's shown in the news and media every day, and losing their jobs, losing their livelihood, while behind the scenes during that same period of time, the rich got even richer, and you see a full correction of the crash and going to all-time highs here, right? During this exact same period of time and date, March 2020, when the Feds exponentially took the first step of increasing money supply, the cartel of the currency, taking that money supply and bailing out the institutions, the corporations down the line, and starting to flood the market through their asset purchase program, you had a few things take place. Everything started to go up in value, all assets, because of inflation, right? The basic definition and understanding of inflation is that when inflation is going up, everything within that economy goes up. Now, for the ultra rich and elite, for the ones who control our day-to-day lives and economies, inflation to an extent before reaching hyperinflation levels is a benefit for the rich and wealthy, because majority of the free money of the rich and wealthy goes into investment and goes into ownership. If you look at the majority of wealth of any billionaire or 100 millionaire or any major successful person, it's not in free cash. It's in housing, it's in land, it's in the stock market, it's in their business ownership value, it's in commodities, it's in gold, right? So if all of their wealth is in these assets and inflation is inflating the price of these assets, their wealth just essentially increased. So to an extent, the money printing, which directly leads to inflation, is a benefit for the ultra rich and wealthy. But everything has an expense. Everything has a cost. This money printing and benefit in the short term for the ultra rich and wealthy, which had commodities prices, which had commodities go through the roof, gold go to all-time highs at 2075, housing prices in North America go through the roof, stock market increase in value, with that being another reason why the stock market was also increasing, right? But who pays the price? Well, the same person who pays the price in history all the time, the common folk, the 99%, the general public. You say, Jeeve, how do they pay the price? Well, for the common 99%, the majority of their money goes into consumables, goes into consumption. They have to pay their cost of living. They have to pay for their rent, their groceries, their gas. That the majority of the money they make from their low wages and low income goes into consumables. So inflation, it inflates the price of all the assets for the rich, but it inflates the price of all the consumables for the working class and for the poor. It makes living even harder for them, right? But this cycle continues to repeat in history because off the backs of the working class, off the backs of the poor, it's proven in history that the 1% have always gotten richer and more powerful, while at the same time manipulating the middle class and working class and poor, right? So now, this is the current issue. You can see from this crash point, the Federal Reserve came in and started increasing money supply. I'll even write it down for everybody. Actually, you guys can just pay, I don't want to waste too much time. You guys can just pay attention to the words. So the Fed started coming in, increasing money supply number 1, which is just a magical digit on a screen. There's not money printers, it's not some printers in a room. It's just a digit on a computer, and they increase the money supply as per their plan. $18 trillion printed. Increasing money supply without demand for it on the other end instantly increases inflation, instantly devalues the currency and increases inflation, right? That's just basic economics. But that inflation in the short term and to an extent is good for the ultra rich and elite, bad for the working class and poor, right? So $18 trillion is printed out. $2 trillion is given in stimulus checks to the working class to distract them, to make it look like the government is helping you, to make it look like the government has your best interests in mind. $2 trillion packages. The other $16 trillion went into the financial markets to make the rich even richer than ever before. So at this time, you had the Fed coming in to say they're going to bail the market out, very low interest rates, very low price, all the market whales also jumping in. So you had a huge extension of wealth going well above pre-pandemic highs to all-time highs at 37,000. Now, you might be saying, well, why are we seeing another bear market now? This is because of human greed. The Federal Reserve, the market makers and the 1%, they let inflation get out of hand for too long because human greed wouldn't allow them to stop this greed train. Human greed affects all of us, on small scales to large scales. And at this level, in the billions to trillions of dollars, it is extremely, extremely powerful. Human nature doesn't change, right? That's the one thing you can always depend on throughout history, throughout time, is that human nature does not change. So now, the reason why we are having this bearish market on stocks is because the same conditions that made the stock market so favorable to buy into here is turning into the exact opposite here, right? Remember, The reason why the stock market was so favorable to invest into at this time for the ultra rich and elite was Fed bailout, money printed, asset purchase program, inflation still moderate and just starting to increase, low prices. You had low prices at that time on stocks, low prices on housing, low prices on commodities as oil crashed to minus $40 futures, right? And whales riding the wave, right? These were the reasons that you had such an extended stock market rally to these all-time highs. But inflation is a very, very tricky bitch to deal with. There's something called hyperinflation. If you let inflation get out of hand, you will reach the level of hyperinflation, which is an economic recession or depression risk and catalyst in itself. Now, for those of you who want to learn about hyperinflation more, go study Germany post-World War. Go study countries like Hungary. Go study Zimbabwe in recent history. And go study Venezuela in recent history, right? Hyperinflation is basically the stage of inflation where it is so high that the currency is essentially valueless and so low in purchasing power, and the cost of goods is so high that there's basically no point of having any money. You would need wheelbarrows full of cash to go buy a simple loaf of bread. And that is a catalyst, for economic crisis in itself, right? So extreme human greed due to extending wealth in these markets have taken us to extreme inflation levels in North America, where now the Fed, the central bank, the cartel of the currency, has shifted their monetary policy stance. And here I forgot to include low interest rates as well. Right? So now, this bearish market is induced and created based on human greed. Now, you have all-time high prices, rising interest rates, less support from the Feds, whales cashing out, and recession scares. Because this greed, this human greed extended to these highs, that's not what is alone having a negative impact to the stock market. That human greed and letting inflation get so out of hand is destroying the engine of the economy. Remember, the people that have been paying the expense, the people that have been paying the price, are the working class, the 99%. The same time you had that money printing, the asset purchase program, inflation through the roof, and that huge rally in stock market, you also had a huge increase in consumer cost of goods, right? Where this is even much higher than it is right now. You can see that over an historical period, over a 10-year period, right? You see a consistent increase in inflation, which is very natural. But then from 2020 onward, you start to have an exponential spike in inflation. This increase in inflation of almost of how high we jumped in inflation, in a 2-year period would have previously taken almost 10 years, right? That inflation is destroying the middle class. Gas prices are through the roof. Rent is through the roof. Cost of living and groceries are through the roof. Wages are lower than ever. Economic activity and consumer sentiment is lower than ever, right? If the Federal Reserve and if the government had the best interest of the working class and economy in mind, they would have been raising interest rates a year and a half ago as soon as the US was no longer in lockdown, right? They should have been raising rates starting to combat inflation as soon as the US was no longer in lockdown, which was almost a year and a half to 2 years ago from this current date, right? As soon as there was no more US lockdown, there was nothing to negatively impact economic activity. There's no lockdown. You're having a surge of economic activity and what is called an overheating economy coming out of the lockdown state. You had huge surges in retail consumerism. You had huge surges in jobs as everybody's going back to work again, obviously. You had huge surges in economic activity. But they did not raise interest rates when they needed to. They did not start to combat inflation when they needed to, which should have really been at the start of 2021. They continued their asset purchase program. They continued the pumping of the markets. They continued to allow inflation to rise for another full year and a half because of human greed, right? They are the ones working in hand with the government, with the market makers and so forth, who have created this recession. This is a man-made recession, like the majority of time it is. So now, instead of having a bearish fundamental catalyst like the global financial crisis, instead of having a fundamental catalyst like the pandemic, this fundamental catalyst to potentially see a bearish market and a potential nether crash is induced by human greed and extremely high inflation, right? Now what you have is the central bank raising rates into an economic recession. Raising rates at all-time high prices, so it's no longer favorable to keep buying into the stock market for the whales. You're at all-time high prices. You have no more support by the central bank. You have the central bank raising interest rates, which makes lending less favorable and so forth, which decreases economic activity. You have the middle and working class suffering because of inflation. You have wages very low, economic activity down. Now the reason why we're going to see this downside is because of a recession. Does that make sense for everybody? I know I've said a lot in a very short period of time, but hopefully this is making a lot of sense to everybody. Hopefully it's very useful information, right? So I'm not saying the stock market is going to go to zero, but we are in a phase where we have a fundamental catalyst in play that can lead to a very aggressive stock market correction and potential crash, which we could easily see us come down to 24K, 26K before seeing any potential rally again. The catalyst here was human greed and the collapse of mortgage-backed securities, and of course, the GFC, global financial crisis. The catalyst here was again from all-time highs and the pandemic and lockdowns that occurred, right? The catalyst here at new all-time highs is the Feds in human greed raising interest rates into weakening economies, into recessionary economies. So we have a recession is the main reason for downside and correction here. All-time high price points, raising interest rates, whales cashing out, recession, US going into an economic recession. What we have been seeing over the last period of months is a bear market, but within this bear market, it is very common, if you guys study it before in history, that you see bear market rallies, right? So right now, what we have to focus on is that we're coming to a very, very key price point of interest, which is pre-pandemic highs, right? In my opinion, with how we are having this bearish market, it's not as much of a crash compared to a bearish market that we had towards the pandemic. This is more similar to the 2000 or 2008 bearish market that occurred, where you have a lot of bear market rallies with a lot of retailers and greedy stock market buyers trying to grab the dips, which also just pulls in some short-time liquidity for the whales to liquidate from better price points of interest. But overall, still having the value of the stock market drop due to these fundamental catalysts in play. And now you might say, oh, gee, middle class suffering, that shouldn't have too much of a factor because they don't give a fuck about the middle class. To an extent. Remember, to an extent. Because at the end of the day, the middle class and working class is the engine of the economy. So you can only sacrifice the livelihood of the middle class to a certain point before it becomes counterproductive for the rich. At the end of the day, the people working in the factories, working in the corporations, consuming all the products of the rich, making sure the economy runs, is the middle class and working class, right? So with these fundamental catalysts in play, as long as we have inflation extremely high, as long as we have economic activity down, wages and jobs suffering, we have the Feds continuing to raise rates, we have whales cashing out, I expect us to see this continued bearish market cycle. Now remember, based on human psychology, this bearish market cycle sees a lot of extended bear market rallies. Don't get fooled by these short-term bear market rallies. As long as the US economy is still suffering, as long as the US dollar individually is still holding strength, which is showing investors pricing in more rate hikes to come, as long as the central bank is still raising rates, as long as inflation is still high risk, the majority of these bear market rallies will essentially be very short-lived, and we're still going to continue to have this overall bearish market structure take place. Right? Now, I want everybody to take a quick visual snapshot of this bearish market structure, and of course, I'm going to reference 2008 now, because what we can also see is if we really see the economies enter an aggressive recession, instead of this bearish market cycle, we could just see a straight collapse and crash on the stock market, right? Now let me show you the example here. Look at this. Now see, look at, this is 2008 financial crisis, right? You had a double top signaling not enough buyer order flow or buy side liquidity to break higher. Then you start entering this bearish market where you have what is called bearish market rallies. Very short-term upside moves that don't break the overall structure and then continue down. But as we had a lot more fear-induced, we didn't just continue a weaker bearish market rally, we also had this potential crash occur too. Right? Which ends up breaking below very significant price points of interest, which here we can use this example of these previous highs in reference to the current example of the pre-pandemic highs. So let's look at these previous highs from 2004 to 2005. You had an extended rally, this double top, which signals from a technical pattern perspective, less buyer side order flow. And then because of the global financial crisis being the catalyst at that time, the stock market enters a bearish market, right? But as recession scares and fear, uncertainty, and doubt scares continue to grow, and as soon as you did have a significant break below those previous high price points of interest, you can see you had a crash that occurred, right? So now, take a visual snapshot of this, the 2000 rally to 2008, the global financial crisis, the fundamental repetition, and the technical repetition, right? Now let's come back to current period of time. These were your previous highs, which was the pre-pandemic. You had an extended rally due to human greed and the central bank flooding the market and the whales riding that wave, from this crash point above the pre-pandemic highs all the way into all-time highs. Then you have this technical double top created, which shows a lot more sellers jumping into the market and buyers liquidating out, right? That double top signals that. Then you can see, because of the Federal Reserve starting to raise interest rates, because of them starting to see a shift in the economic cycle, and now you're having here no more Fed support, raising rates, all-time high prices, whales cashing out, recession scares, right? Now you can see that we're in that same bearish market cycle. Now, we can see two things occur. If recession scares continue to grow, Feds continue to raise rates, we can either see a straight come to this below previous pandemic price and an aggressive crash, which would probably at least see a 5,000 point drop roughly to these previous price sensitivity areas, or nonetheless, we're still going to continue to respect this bearish market cycle. Does that make sense to everybody? Is everybody following along? So the key takeaway points. Yes, the stock market is essentially designed to go up, and that's what it's created for, to generate wealth for the few at the expense of the many. But we've already passed that phase of human greed over the last 2.5 years. Now we're in that process where we always have constant economic cycles that can create large corrections and large crashes. Recession fears, poor economic activity, Feds raising rates into a recession, very weak US economy, US dollar going up, obviously more demand in the dollar because of rates going up, whales cashing out from all-time highs and so forth. Right? We also understand why we are in this bearish market cycle. Now I'm expecting two things. Either to continue to play this bearish market cycle and see another short-term pullback phase in continued sells, or just recession fears continue to grow, especially if we have continued weakening US data and us driving down and potentially having a repetition of 2008 global financial crisis, with the middle class suffering even more. Right? Now we can see the same thing. The same time stock market is a lot more bearish, dollar is a lot more bullish. We have continued strength in the US dollar, as with raising rates and interest rates going up, there's a lot more demand in the US dollar, especially as the global reserve currency. Recession scares are global. You're going to see the majority of stock markets following suit and doing the exact same thing, right? So now, diving even deeper into the time frames here. When I'm looking at US 30, I'm expecting two things. If we don't break back above these previous lows at 31K, I could see, if recession scares continue to grow, that we're just going to have a short-term pullback phase in more of a continued impulsive downside move. But if we break back above the previous lows, otherwise I could see us entering a short-term pullback phase which again would be very short-lived, going to the sell side liquidity zone and price sensitivity area of interest before further seeing a continued stock market decline, right? So I'm either expecting short-term pullback and stock market melt, or a deeper pullback but still higher time frame stock market bears based on the technicals, based on market psychology, based on economic cycles, based on the fundamental catalyst shared. Is everybody following along? Is everybody understanding? Okay? Now, for even more information about the recession, about the US dollar, about the Fed money printing, go to this channel and make sure you watch the top-down GBP USD analysis, which gives a full fundamental breakdown on dollar, which is very important. And also make sure you watch the full higher time frame top-down analysis on gold. Now, so when I'm looking at stock market here, first set of trade ideas, 3750 sells, and then scaling back below with breaks below 30K sells. If our short-term sell bias is invalidated and we break back above previous lows at 31,150, then just play a short-term bear market rally to potentially revisit this sell side liquidity zone and order block at 33K flat, right? Because again, based on human greed and based on market psychology, if we have the technical confirmations of breaks back above the previous lows, you can see it is very common to see what is called bear market rallies, right? Bear market rallies here. And each of these bear market rallies, you obviously don't want to be selling. You want to be taking advantage of the pullback in the short term to jump back into the higher time frame sells. So if we break back above previous lows in these rejection points, that shows me higher probability of a bear market rally before we see more sells to the downside. Everybody following along? Right? So that's why the trade ideas would be either just short-term pullbacks for this new weekly candle and sells from these previous key sell side liquidity zones, or short-term buys above 31,150, a short-lived bear market rally before continued higher time frame sells. Main bias on the higher time frame fundamentally, technically, is bears on the stock market. More confirmations of seeing stock market bears and correlation factors for everybody would be dollar continuing bullish. If dollar doesn't break back below these previous highs and continues bullish, that means there's more demand in the US dollar and liquidity being generated in there as investors and the market makers are pricing in more rate hikes to come by the Feds, the cartel of the currency. Another great catalyst to see some more downside on the stock market and use a correlation factor is the volatility index trading above 34. If VIX starts breaking above 34, the stock market's going to have a collapse and dump. Another correlation factor is if you see global equities in other regions from the Eurozone to Germany to North America still continuing bearish as well. This shows you global recession scares are high. Global central banks are all raising interest rates. Bank of Canada, Bank of England, ECB is even going to be coming out of negative territory. Reserve Bank of Australia, Reserve Bank of New Zealand, they're all raising interest rates. They're all seeing the same recession scares, all facing very weak economies. So if you see global regions going down, dollar strength, VIX being bullish, US 30 respecting those price points of interest, we have a lot of point to see an economic recession and a bearish market on stocks continued, right? And for those of you who know me and have been following Capital Hungry, to know I'm not just talking in hindsight, a lot of you will know that at least since March 2022, I've been calling the US stock market sells. Ever since the Fed has started to give signals towards rate hikes, towards actually raising rates, after this double top here, similar to 2008, I've already been playing dollar strength for a year and a half and already been calling the stock market bears, real estate market bears. I called the crypto crash 8 months ago. All of that is with proof on this YouTube channel, right? So make sure you guys watch those other videos I referenced to you. Make sure you check out all the other educational content, of course, on this YouTube channel. Check out all of your resources and links shared in the description. That When I'm mumbling this much now and slurring my words, I've been talking too much, and it's time for me to take a break. So everybody, thank you for watching. Hopefully that was very informative to you, very educational. I'm going to save and upload this. It's going to be available to rewatch as you wish. I'll get some chapters added to it as well. And everybody take care. Have a great day. And I'll see you guys for the Monday market update. I'll see you more often on Raja's trading streams as well. And yeah, take care.